All right. Today is Tuesday, March 21st. This is a recap for the stock market activities today. Now, folks, I got a good one for you tonight. And let's begin with this. We're going to keep it short and sweet because we have an important day ahead of us tomorrow. FOMC, whatever comes with it, perhaps one of the most important Fed meetings and Fed decisions ever. And of course, expectations are all over the place, but now we have a consensus that it's going to be 25 basis points and then fill in the blank. And if you watched my show in the last few days, you know that I'm in the camp of it's going to be 25 basis points and then an announcement of a pause. Whether that's going to be explicit or not, that's up for grabs. Because the Fed is in a massive dilemma right now. We know that inflation is not subsiding, inflation is moving higher. Take, for example, Jerome Powell's own favorite indicator, which is core services ex housing. The reading accelerated month over month dramatically, the highest reading since the summer of last year. And we all know that to tackle inflation effectively, the Fed funds rate must be positive. And as we stand right now, the real Fed funds rate is actually negative, meaning the Fed needs to do more hikes to get the reading into positive territory, and then they get a chance at tackling inflation down. The problem is, on the other hand, they have the systemic risk problem from banks imploding. The entirety of the economic system has been bloated with debt in the last few years due to quantitative easing, and now any rate hikes, as modest as they've been, things start to blow up. And since we have fears of systemic risk and we have financial conditions tightening dramatically due to the fear of systemic risk, the Fed can no longer go bold. They can no longer go big by doing 50 basis points, which would have taken them as close as they can get to positive real Fed funds rate and maybe a better chance at tackling inflation down. So we know that 50 is out of the window. And the debate right now is it going to be a pause and that's it? Let's pause and reassess. In my opinion, this will be a grave mistake because it will send the wrong signals that either the systemic risk is so severe that we will see an implosion coming and the implosion will take care of the inflation problem and therefore the Fed is surrendering and therefore the resolution to this dilemma is to raise and pause. So I'm in that camp right now and the odds say that we have over 86% chance that we will get a raise of 25 basis points in tomorrow's meeting. But this was not the case a week ago, 2 weeks ago, amidst the implosion of Silicon Valley Bank. The odds were saying that we will have almost 100% chance of a pause. So the market reacted based on that particular odd, that we're going to see a pause. And this is what we saw in the sectors of the stock market. Of course, they followed the movement in the dollar and bond yields. The dollar weakened, but we did not see a massive drop in the value of the US dollar. Yet we saw massive volatility in the bonds market with massive crashes in the 2-year yield, for example. And these sectors of the stock market reacted based on the reaction in the bond market, which was signaling a pause with different interpretations. For example, technology went higher. Why would technology go higher if we have systemic risk and bond yields collapsing? The reading is not, oh, we have a systemic risk or a risk of a recession. The reason why technology, and you can lump the RKK names, the profitless technology, all under the banner of tech, they all moved higher based on expectations that the Fed will pause rates. Not only that, but also will cut rates ASAP. And this will have an expansionary effect in the stock market. Think about it as easing and more liquidity being pumped into the stock market, aka the resumption of QE. This is how tech read it. This is how cryptos read it too, by rallying significantly higher. But we saw different reactions in other sectors. For example, banks went down dramatically, indicating a recession. They read the move in the bond market of a Fed pause as recessionary. Consumer staples caught a bit. They've been hammered year to date under the assumption of an expansionary theme, but staples recently caught a bit because that's what they do under a recession theme. Likewise, utilities, when bond yields move down because we have a recession, you gotta look for yields back in the stock market, but you also have to look for stability. And utilities are stable, number one, and they pay high dividends. And therefore, utilities caught a bid. They read the action in the bond market as, oh, this is a recession coming. So did healthcare. And of course, bonds, prices shot up higher, the rush to safety by investors, and yields went down dramatically. The move in the bond market was screaming, this is a recession coming. Gold caught a bid based under this assumption too, and oil prices crashed under the assumption once again that this is recessionary. So we have a conflict here. Are technology and cryptos saying the right thing, or is the rest of the market saying the right thing? Because we know the moment the odds shifted from a pause to 25 basis points this week, the reactions changed. We can say, of course, that the majority of the reactions are due to de-risking ahead of the FOMC. For example, charts that became really oversold caught a bid, short covering, de-risking ahead of the Fed. That's understandable. But here's the other problem. If the Fed indeed going to raise by 25 basis points, does that really say that we have a recession coming? Are they going to raise rates as we face a recession on the horizon, perhaps coming really soon? What we know for now from the reactions that we got so far this week is the following. Technology and cryptos continue to rally under the assumption that this is an expansionary theme. Fed liquidity, QE, we're back to partying, baby. Banks caught a bid, and again, a lot of this is short covering, but a lot of it is also a reinversion into the inflation theme, out of the recession theme. And this is due to bond yields recovering and moving higher again. And then we have staples still catching a bid, still saying that this is a recession. You want to be in staples. On the other hand, utilities got absolutely hammered today. And the assumption is bond yields are about to move higher because the Fed will raise, and this will get us back into the inflation fighting mode, in which you don't want to be with utilities because the fixed income market will give you more. And that's risk-free. Healthcare. The action remains neutral, but it continues to catch a bid. Now, healthcare has been getting hammered, at least so far this year, and the reason is we reverted back to the expansion theme, the false assumption that, we're seeing inflation subsiding and the economy is doing okay, hence we have the soft landing. You know the story. But now all of a sudden healthcare is catching a bid. Well, if we are in the inflation fighting theme and bond yields are moving higher, why would I take the risk in looking for yield in healthcare when I can get it in the fixed income market? In the beginning, the inflation theme was good for healthcare, but now the bond yields pay you more than any of the dividend yields in Big Pharma, for example. What is the point of investing in healthcare? Healthcare becomes attractive and rallies higher under a recession theme now, when bond yields start to go down because the economy is weakening, and then healthcare becomes attractive again. So the fact that healthcare is continuing to catch a bid even this week indicates that healthcare sees it as, a recession is coming. On the other hand, we saw bonds moving down and bond yields recovering, be it slightly, which means they're reading the 25 basis points odds as, we're back at the inflation fighting theme. Similarly, gold went down this week, not by a lot, but it did rally last week under the assumption that this is the beginning of the recession. Now it's looking at it as, okay, let's de-risk here after a massive rally, because what if this is going back to the inflation fighting theme of the Fed raising rates even further, the 25 basis points? What if the Fed says, yeah, we're gonna raise and pause, but the Fed dot plots indicate a higher rate in the future? So we see de-risking here in gold, at least so far this week. And lastly, oil crashed in the last 2 weeks. This week so far, it's catching a bit. Part of it, of course, is short covering, de-risking. But what is oil saying right now? Inflation is not subsiding, and the Fed will have to go back to the inflation fighting mode. And as long as they do that, the biggest boogeyman for oil investors, the recession, is not as close as we thought. This is what the action is saying right now, at least so far in the last 2 days. Now, what will happen? What will be the reaction of all of these different sectors if we have indeed the raise and pause? Whether the pause is announced explicitly or not, what would be the reaction? The answer is, I have no idea. If I did, I wouldn't be doing this show. I'd be hiding in a bunker, being busy, becoming the richest man on the planet. But we can read the charts and hear what they're whispering to us, what they're saying, where the risk is. So we start with technology, for example. What we know is, if we look at the options grid for the QQQ, the NASDAQ, these are the options with the expiration date of tomorrow, which will influence the market maker's decision. We know that the highest open interest right now is about 5,000 for the 310 strike. That's in the money, but there's not a lot of open interest beyond that. Meaning, if the dealer, aka the market maker, wants these people to lose their money, they can move the Qs down a little bit. The problem is, what if we have high open interest for puts too? Then their ability to move the chart down comes at a price, which is now they're obligated to satisfy put options holders. And it's a balancing act by the market maker. So now when we look at puts with the same expiration date of tomorrow, we see that the highest open interest is at 305. It's not a major volume of open interest. We know the most open interest right now is at the 300 level. But sake of argument, looking at 310 highest number of open interest for calls, the 305 highest open interest for puts. This allows the market maker to move the Qs below 310 all the way to 305, and the market maker will be happy if they close at 305.10, 305.5. That way they can induce maximum pain to the majority of contract holders. Well, gee, what is the importance of these numbers? When we look at an hourly chart for the Qs, what do we see here? We're now at 310, but the chart is getting really overbought on the RSI, meaning that the risk is to the downside. We know that we have a gap at around 305.91. So let's say that the market maker moves the chart all the way to close the gap. That will be their objective tomorrow, to go down, close the gap, induce maximum pain, and that's that. And the chart is not going to change from being bullish. It remains bullish. It did not lose an important support here. The most important support, of course, being 303.30, and then the ultimate one is 300. But what if we have major volatility because of the FOMC? Let's say the dollar explodes higher, yields explode higher. Jerome Powell issues bullshit assurances, oh, the banking sector is fine, we're going to raise rates, but he doesn't announce a pause. Leaves the door open for more rate hikes to come. That we could see a lot of selling, because the assumption behind the rally in the Qs is we're going to have a pause. Whether it's going to be a plain vanilla pause or comes with a 25 hike, then a pause. Then the market maker will face a lot of pressure, this time around from selling. We can see them moving the chart all the way down to 300, which is the most important level of support, number one. Number two, the contract with the highest number of open interest when it comes to puts. In plain English, Maverick, what does that mean? Even if the chart goes all the way down to 300, the dealer will be happy. Induced maximum pain on pretty much everybody. But what if the selling pressure is too extreme? We crack below 300. All of a sudden, now the market maker has to hedge by dumping more shares, because a lot of these 300 contracts are now in the money, and they're obligated to cover for that by the end of the day. So the dealer will start selling a lot of shares of the Qs if they sense that this is going to go below 300 ahead of time, and this could produce a massive pullback. So this is the scenario that we could see here. The risk is not to the upside when we look at the Qs, at least from the hourly perspective. The risk is to the downside. Yet when we look at the futures contract, the daily chart, what do we see here? It remains positive. The MACD indicator, the RSI, all pointing out for more strength to come. The problem is the RSI is getting closer to overbought territory. So let's say we have a rally in the morning that gets us all the way to the next resistance at around 12,987. Let's round this up all the way to 13,000. And then we get the FOMC and we flush down. The question becomes, are we going to lose the support of 12,766? If that is the case, no biggie. Are we going to go down and lose the support of 12,207? Then we got to reverse it. But for now, the daily chart remains positive. So when we talk about the risk, it remains to the downside in the aftermath of the FOMC. Yes, the chart is positive, but what if we have a gap and then crack? So we have to look at more charts here in the technology sector. We start with Apple, an hourly chart. What do we have here? Look at the RSI. Overextended at the risk of pulling back if there is any disappointment, because the market action right now is pricing it to perfection. What does perfection mean? It means a pause. They have to get a hard pause from Jerome Powell. Even if he raises by 25 basis points, he has to say, folks, I'm gonna pause. And by the way, I see rate cuts coming too. If he says that, then Apple would rally. Absent of that, the risk says it's gonna go down. We have a rising wedge here, and at any disappointment, a chart that is overbloated heading into an important event is at the risk of pulling back. The good news for the bulls is we have plenty of support here. We have 157.24. If that's broken, we have 154.60. And the chart will remain positive until and unless it closes below 150. We'll look at another one, Google, a daily chart. Where is the risk here? Is the risk to the upside? The answer is absolutely not. The chart is overbought, overextended. Look at the RSI. It is at an important resistance level, 105. It held on over and over and over and over again in the past. If we don't get a hard pause, and honestly, what these charts are looking for is cuts. If we don't get a cut, at least announced in the future, we will see a pullback in technology. Google will lead that pullback. And you can trade that, of course. Now, are you going to trade it before or after? That's your call. It's the business of risk here. Some folks have higher risk tolerance. They want to get ahead of the move because they're seeking the highest reward. Other folks say, I don't care if Google pulls back after the FOMC. If it does, there is plenty of meat in the bone. I can chase the move later on, and I'm still going to score. But what is the point of chasing the move ahead of time, and then we see the chart continuing to move higher for whatever reason? So it all depends on your risk tolerance when you make these trades. Another important technology chart is Tesla, an hourly chart. We got a massive pop today. Couldn't make it above 187.68 naturally. So obviously they had to cheat and gap higher. Based on the news, of course, that now they have an upgrade out of junk status in bonds. Whether the sales in China are improving, it doesn't matter. What matters is the chart is now above 187.68 and above the important number of 194.55. That would be support. But look at where the RSI is. It is way overextended in a short amount of time, meaning the risk is to the downside. What if Powell says, okay, we'll do 25, the banks are stabilizing, there is no need to announce a pause? But we'll be data dependent. That's not going to be good enough for this chart. That's not going to be good enough for the Qs, for Apple, for Google, for RKK, and therefore we'll see a pullback. Now Tesla has 194.55. If that's lost, we're going to have a legitimate retesting of 187.68. If that doesn't hold, then we go down and closing the gap. Now here's another one that we talked about in the morning brief today. It did not play out, but it could be a good candidate for a pullback tomorrow. Here's an hourly chart, way overextended. Look at the reading of the RSI. We have support at 365 now. If the market doesn't get what it wants from the Fed, if the Fed is slightly hawkish, if the assumption that we have the resumption of QE turns out to be wrong, Adobe will pull back big. So this is yet another candidate for a pullback. Another one, AMD, an hourly chart, been riding high as of late under the assumption that we have the resumption of the expansion theme, the Fed is going to cut rates, the Fed will add liquidity, yada, yada, yada. But it seems that AMD is stalling right now at around the support/resistance of 95. We know that AMD and many chips are sensitive to the dollar. The dollar has been going down as of late. But what if it moves higher? And I will show you the chart. It says there's a high degree of likelihood that the dollar will pop higher tomorrow. If it does, AMD pulls back, and the support that we have is 89. So the risk is to the downside once again. All in all, you put it together. What will be the likely scenario, the likely reaction for technology after the FOMC? The most likely outcome is a pullback. Unless, of course, the assumption of the expansion, the resumption of QE is proven to be right, which is a long shot. And the same goes for cryptos. When we look at Bitcoin, this is a daily chart. It is overbought, quote unquote. It is above an important support now, 26,555. It is priced for perfection. It is priced for all the Fed is easing now and allowing risk assets to move higher. Bitcoin is looking for a cut. What if it doesn't get a cut? Then it will get a haircut instead. And it will move down and lose 26,555 for support. Now, if you're not going to trade cryptos via Bitcoin, you can trade them via Coinbase. Here's a daily chart. Again, look at the RSI. We have an important resistance here, which could be a double top at around 87.83. What if we gap higher in the morning and we get the RSI to overbought readings, quote unquote? And then comes the FOMC. What is the risk here? The risk is to the downside. The Coinbase will not get what it wants, what it rallied based upon, which is a rate cut, not just a pause. What is the risk here? A pullback, a sharp one. This opens a trading opportunity for you if you believe that this will happen. So again, the risk for technology and cryptos in tomorrow's reaction is to the downside. What about banks? We will look at the XLF, a weekly chart, because the daily, of course, is rebounding based on severe oversold conditions. Lots of short covering. But what about the long picture here? You know that we have an important support at 31, in or around this number. The momentum is negative for now. And whatever Powell is going to say, he might issue some reassurances that our banking sector is fine, yada, yada, yada. But banks are looking for not only a pause, but also a rate cut. If Powell is about to raise rates by 25 basis points, I announced that the fight against inflation is not over, and maybe he needs to raise even more in the future. Then we go back to the same systemic risk that a lot of these banks are setting on losses, unrealized losses. If the Fed is about to raise rates even more, the systemic risk will intensify. And then, if 31 is broken, we're going to go down to 25 to close the gap, but this is a weekly chart. It's going to take a long time. So again, the risk in tomorrow's reaction for banks, it depends. I would say 70% to the downside if Jerome Powell indeed raises and then maybe does a soft pause, not a hard pause, and maybe says, oh, but the inflation problem is too much. We're taking care of banks. We bailed them out, so we don't see the reason why we should do a hard pause or a cut right now. Banks are not going to like that. But what if Powell also announces more facilities to rescue a bank and keep them liquid? Maybe they would like that announcement, and we see more short covering at least all the way to the end of the week. And therefore, I say it's 70-30 to the downside. When it comes to staples, let's look at the XLP, for example, a weekly chart. We know that the bullish trend is done. It's over. We have a negative downward sloping trend, which means that the chart is bearish for now. And it lost a lot of steam this year, and the reason is the assumption since the beginning of the year is we're going to have a soft landing, the Fed is going to pivot, and you want to be with risk assets. You don't want to be with defensives and risk-off assets. But now, as the fear of recession starts to creep in, all of a sudden consumer staples are becoming attractive again. And is what we're seeing right now a formation of a cup and handle, and then run a retest at the sloping line of resistance? That's possible, of course. And therefore, I see staples as safety because they're not going to have this massive oversized reaction one way or the other. There's steady eddy, and for now the assumption is to the upside. Think about it this way. Let's say Jerome Powell says we're going to raise rates by 25 basis points and then pause. Staples could read this as, oh, he's pausing because he knows that the economy is weakening and we're about to head into a recession. And maybe we're getting closer to stability in yields. They're going to freeze at these levels, if not move down, in the weeks to come. And this will make staples attractive again. Then they rally. What if Powell announces a pause right away? Staples win. What if Powell announces rate cuts? That's also going to be positive for staples because they're becoming more attractive versus bond yields, number one. Number two, why is Powell cutting rates right now? Because we have a recession. Then the recent rally in staples is verified and justified. And therefore, I like staples here. We'll look at utilities. In the morning brief, I shared this chart with you, an hourly chart, and we said today that yields are going to rally ahead of the FOMC, and utilities will probably not like that. And we saw a sharp pullback in utilities. What is the message here? The message is we think Powell will raise rates. Maybe he's not going to announce a pause. Maybe he's going to slam the door shut against any rate cuts to come because he doesn't want to freak the market out. Then bond yields will move higher, and utilities will not become attractive again. And the risk becomes to the downside. But I would say that the pullbacks in utilities will be an opportunity to buy because let's say the Fed manages to thread the needle correctly tomorrow and they say, okay, we're not going to abandon the fight against inflation, we're raising rates, or we might need to raise them further from this point on. But we're also taking care of banks, we're putting the fire down. We will respond to whatever systemic risk comes in the near future, meaning we will cut rates if that's what it takes. Sooner or later, something else is going to blow up. If bond yields recover and move higher, as we anticipate they will, something else will blow up. And then the Fed will have to cut rates. And the bond market will do it before he does that. You're going to see yields in the 2-year moving down dramatically. You're going to see the yield curve steepening once again. That will be the beginning of the recession. It's already happening, by the way. Whatever pop we get from bond yields, it will reverse down after something else and something bigger blows up. Then you see utilities recovering again. But the immediate reaction for utilities, I would say the risk is to the downside because we will see a pop and recovery in bond yields. When it comes to healthcare, you can look at the XLV, for example, neutral, daily chart. There's nothing to see here. The momentum is positive. We have 129 as the next resistance, for example, and the same argument we did for staples is applicable for healthcare. It's a winner either way, and therefore I concentrate on staples and healthcare. I like both. It doesn't matter what happens in the FOMC, aftermath of the FOMC, 2 weeks from now, 2 months from now. We know the inevitable destination is a recession, and these sectors tend to thrive under a recession. They're not going to be immune if we have a crash event, but then they're going to catch a bid and outperform the rest. Now, when it comes to bonds, let's look at some charts here. We do the daily chart for the 2-year yield, which is the most important indicator for Fed funds rates. Massive crash, and the assumption is Powell is going to raise by 25 basis points. This should take the chart all the way to close the gap at around 4.6. But what if he says pause? How would the market read that? Will the rebound happen to begin with? Will the market read the pause part and ignore the raise by 25? We see the chart moving down further. I'm not in that camp. I say it's going to pop higher tomorrow, maybe close the gap, or get as close as it can get to closing the gap. And then it moves down again as something else blows up, as we see more weakening in the data, and the bond market says, okay, the next step is they're going to have not only to pause, but they have to cut rates because things are exploding. The economy is now in a recession. And that's my take for now. We look at the 10-year yield, for example. What do we see here? Catching support, closing above 3.5, and the assumption is it should pop higher tomorrow on the announcement of 25 basis points hike, maybe all the way to 3.8, and then we start to get more and more bad economic data, and we see the 10-year moving back, not at the same degree as the 2-year. So the yield curve will continue to steepen. By the way, a solid indicator the economy is heading into a recession. So you look at the TLT, for example. Daily chart, we talked about the bear flag. The expectations are in tomorrow's session, it will go down further. So when it comes to bonds, bond prices, the expectations, at least from my end, prices will go down, and then yields recover for a little bit. Now, what about the old man gold? Because it rallied significantly higher under the assumption that we have a recession coming. But in the last 2 days, all of a sudden, the assumption becomes, okay, they're going to raise by 25 basis points. Maybe the recession is not going to happen right away, and therefore the pullback in gold, although it did not lose any important support. So can gold move higher again tomorrow? Sure, of course. It is possible. But it is contingent on the dollar going down. It is contingent, in other words, on the Fed announcing a pause, not raising, and perhaps even going further as announcing or forecasting rate cuts. If that is the case, then gold recovers. Otherwise, it will lose 1928 as support. We see a recovery in the dollar, a recovery in yields. This will last for maybe a few days, a few weeks. Then we're going to run into another accident. They will go down and gold will catch a bid again. This is my forecast for now. When we look at oil, of course, massive crash. The assumption is a recession is coming, and the recession will come. But now we have a recovery because Powell is raising rates, so maybe we're going to see maybe not a hard recession, instead maybe a stagflation phenomenon in which the economy weakens, but oil prices remain elevated. We're not talking about the hundreds, we're not talking about the 90s even. We're talking about 60s and 70s. Right now, the chart of Brent oil, the daily chart says we have some short covering that took place in the last few days. Last 2 days, we should say. But does it change anything at all? Until the chart recovers and closes the week above 77, we can't say anything here. We can't say that the risk is to the upside. The risk remains to the downside in oil. And now you can fill in the blank, whatever the reason is going to be for oil to move down in the aftermath of the FOMC. Maybe they're reading the pause as a signal for a recession. Maybe the dot plots are signaling cuts, and that will be interpreted as a recession is coming. What I know for now, we could also see a phenomenon that is really interesting. More short covering in the futures, in the commodity itself, in Brent oil. Let's say if the Fed doesn't announce a hard pause or rate cuts. But what about oil stocks? Look at the hourly chart for ExxonMobil, for example. Massive pop, the RSI is getting way overextended. The risk is to the downside. The risk is in the aftermath of the FOMC, Exxon will move down. That gives you a trade. We talked about my straddle trade at around 100. I bought the 100 calls and the 100 puts. The move that I did today is closing the 100 calls, pocketed the profits, thank you so much. And now maybe the move is doubling down in the puts under the assumption that Exxon is going to move down and crack below 100. And that will be the resumption of the recession theme. So in summary, folks, what we're looking for in tomorrow's activities, we're going to watch gold, we're going to watch oil, we're going to watch bond yields, the Qs, everything. And we want to come up to a conclusion here. Is the market reading this as, okay, this is the beginning of the recession? And if it is, we need to see reactions. Or is the market reading this as recession averted for now? Are we going to go back to the inflation fighting theme by the Fed? Or will the Fed announce rate cuts and get us back into the QE mode of expansion, which cryptos and the Qs are assuming right now? My call is the immediate reaction will be the resumption of the inflation fighting theme. And then something else will happen in the next few weeks, another accident, which will push us back into the recession theme. That's my call. I could be wrong. Do your own homework, assess the situation, and trade accordingly. But before we wrap it up, let's look at the SPY, the S&P 500. What do we see here in the options grid? These are the expirations for tomorrow. We can see that the highest number of open interest for calls is at the 400. No surprise here. It is out of the money right now. The market maker is not under any risk right now of being called on this. But my hunch is, what if we get a rally, a pop in the morning, and the market maker's intention behind the move of pumping the SPY higher in the morning is to get those 400 contracts to book profits and de-risk before the FOMC. And then the dealer moves the SPY in a flush down to get rid of all of these contracts with big open interests above 5,000, above 4,000. The problem is, where will it stop? Well, that depends on puts, doesn't it? Because if we have higher open interest for puts too, there are consequences for the dealer. When we do that, we can see that the open interest is anemic for puts with the expiration date of tomorrow, with the exception of the contract of 390. In other words, the dealer has the room to pull the SPY down all the way to 390, but not close below 390 by the end of the day. This is the goal. This is the aim. And surprise, surprise, when we look at the chart, an hourly chart for the SPY, what is the significance of 390? We know 400 is the upper target. Let's say we gap higher in the morning. We take care of those call options contracts. They book their profits. The chart becomes really overbought in the RSI. And then comes the flush down all the way to 390, which happens to be the most important support. And it also coincides with the trend line. Meaning, if the SPY moves all the way down to 390, it remains holding at a bullish trend line. And this is what the market maker is aiming for. Now, if Powell screws up and we have massive wave of selling, for example, then the market maker will have to scramble and sell more SPY shares. We're not going to see 390 holding. We go back all the way down to 385. Is there a scenario of the SPY moving higher? Yes, there is, but it is contingent on the Fed announcing a hard pause, if not rate cuts. The majority of the corners in the stock market that are rallying right now are assuming that there are rate cuts coming. If Powell shuts the door on rate cuts, it's really hard to see any rally continuing here. And lastly, the most important chart is the Dixie. It bounced from the important support of 103 today. My hunch is, whatever Powell says, it's a really hard call, I admit, but my hunch is the immediate reaction will be a pop in the dollar. Then in the next few weeks, something will happen. Economic data will come out weak, indicating a beginning of the recession. Something else is going to blow up, and then we see the dollar moving down again. And by the way, there will be a buying opportunity for gold, as we talked about before. This is my reading for now. You can hear a lot of analysts and commentators saying, oh, if this happens, this will happen. If this happens, this will happen. I have no idea. I'm just giving you all the possibilities. So whatever happens tomorrow, I'm not going to be embarrassed. I'm going to sound right either way. I'm not doing this bullshit in this channel. I'm giving you all the scenarios, but I'm telling you how I see it too. And my reading for now is we will see the resumption of the inflation fighting mode tomorrow, and then we're going to reverse back into the recession theme. Lastly, what do we have on the economic calendar before we wrap it up? Surprise, surprise, we have the FOMC, and most importantly, the conference by Chairman Powell. With that, folks, it is a short show tonight. Sorry for the disappointment, but we're going to resume a full coverage tomorrow. I just wanted to get this out to you as soon as I can so you can go ahead and look at the charts, my reading of the situation, because we have an important day ahead of us. We have to be ready tomorrow. And there is no point of talking about any other issue in tonight's show. And with that, folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Take care.
You gotta stay relaxed. Yeah. You jerk off?